If you own property in the UK, you need to hear this right now. Because 2026 could be the year some UK cities see serious house price drops. And if you're in the wrong area, you could be sitting on a ticking time bomb. Today, I'm breaking down 10 UK cities where house prices could crash in 2026, why it might happen, and whether you should seriously consider selling now. Welcome back to UK Housing Reality, the channel where we cut through the headlines and look at what's really happening in the UK property market. Now before we start, this isn't fear-mongering. Property markets don't crash everywhere. At the same time, real estate is hyper-local. Some areas will hold steady, some will grow. But others, especially those exposed to oversupply, weak local economies, high investor activity, or affordability pressure, are far more vulnerable. If interest rates stay higher for longer, or if the economy slows again in 2026, let's get into it. First on the list is Birmingham. Over the past few years, Birmingham saw huge investor demand, off-plan flat developments, and strong price growth driven by regeneration and HS2 expectations. But here's the risk: a heavy pipeline of new apartments, combined with stretched affordability. If demand softens or investor appetite drops, city center flats could face significant downward pressure. Areas packed with new builds are particularly exposed. Next is Manchester. Now Manchester has been a property hotspot for years, but that's exactly the concern. When a market becomes heavily investor-driven, especially with high-rise apartments, it becomes more sensitive to rental yields and interest rates. If landlords start selling due to tighter regulations or falling yields, supply could flood the market. That's when prices fall fast, especially in the city center flat sector. Third, Leeds. Leeds experienced strong post-pandemic growth and plenty of new developments. But wage growth hasn't always kept up with house price increases. If mortgage rates remain elevated into 2026, affordability pressure could limit new buyers entering the market. Markets that rely on first-time buyers are vulnerable when borrowing costs stay high. Fourth is Nottingham. Nottingham has attracted buy-to-let investors due to relatively low entry prices and student demand. But student markets can be volatile. If rental demand softens or landlords continue exiting due to tax and regulatory changes, prices could see a sharp correction, particularly in investor-heavy neighborhoods. Number 5 is Liverpool. Liverpool saw strong investor interest, particularly in apartments marketed overseas. Whenever a market becomes dependent on external investor demand rather than local owner-occupiers, risk increases. If investor confidence drops, those markets can reverse quickly. Oversupply of flats is again a concern here. Sixth on the list is Sheffield. Sheffield benefited from affordability compared to other northern cities. But that affordability advantage narrows when borrowing costs are high. If first-time buyers struggle with deposits and mortgage approvals in 2026, demand could weaken significantly in entry-level housing segments. Now let's talk about London, specifically certain boroughs, not the entire city. Prime Central. London has already gone through corrections in the past decade. But outer boroughs that surged during the pandemic, driven by remote working and space demand, could see pullbacks if buyers return to offices or if affordability bites. Areas that saw rapid price growth between 2020 and 2023 are especially vulnerable to reversals. Eighth is Bristol. Bristol has been one of the strongest performing cities in the UK property market. But strong growth often leads to stretched valuations. When prices rise much faster than incomes, markets become fragile. If economic growth slows in 2026 or unemployment ticks up, higher-priced regional cities like Bristol could see sharper corrections than expected. Ninth, Leicester. Leicester has a mixed housing market with strong rental areas, but also wage sensitivity. If small landlords continue to exit the market due to regulatory changes, Increased supply of ex-rental properties could weigh on prices. Markets dominated by smaller terraced housing owned by landlords are especially exposed to policy shifts. And finally, Cardiff. Cardiff experienced steady growth and strong demand from both local buyers and investors. But like other regional capitals, affordability is tightening. If the wider UK economy slows or mortgage lending criteria become stricter, marginal buyers could disappear, leaving sellers competing more aggressively on price. Now let's step back for a moment. Why 2026 specifically? There are several potential pressure points. First, many fixed-rate mortgage deals taken out during the ultra-low interest period of 2020 to 22 will have fully reset by then. That means homeowners could face significantly higher monthly payments. Some will absorb it. Others won't. Second, if interest rates don't fall as quickly as expected, affordability remains stretched. Even small changes in rates massively affect borrowing power. Third, landlord taxation and regulation continue to change. If buy-to-let investors accelerate their exit, certain city centers could see a wave of listings. Fourth, new build completions. Cities with large development pipelines face the risk of too much supply hitting the market at once. But here's the important part. A crash doesn't mean a 50% collapse everywhere. In property terms, even a 10 to 20% correction in specific postcodes feels like a crash, especially if you bought recently with a small deposit. So should you sell now? That depends on your position. If you're highly leveraged on a variable mortgage or sitting in a city center flat in an oversupplied market, it may be worth seriously reviewing your risk exposure. If you're a long-term homeowner with manageable payments and no need to sell, short-term fluctuations matter less. If you're an investor with thin yields and rising costs, 2026 could be the year margins get squeezed hard. The key is not panic, it's preparation. Look at supply in your local area. Check how many similar properties are listed. Monitor how long homes are staying on the market. Watch price reductions. These are early warning signs. Property markets turn slowly, then suddenly. One more thing. Some of these cities will also have areas that perform well. Desirable family neighborhoods with limited supply often behave very differently from investor-heavy apartment zones. Micro-location matters more than ever. At UK Housing Reality, we focus on data, trends, and risk, not hype. The UK property market is entering a more fragile phase. Debt levels are higher, affordability is stretched, and investor sentiment is shifting. If you're thinking about selling, 2025 might offer stronger conditions than 2026 in vulnerable cities. If you're thinking about buying, patience could give you better negotiating power next year. The winners in property are not the people who follow headlines. They're the ones who act before the crowd. If you found this breakdown helpful, make sure you subscribe to UK Housing Reality for straight, data-driven analysis on the UK housing market. Drop a comment below and tell me which city you think is most at risk in 2026. And if you want a deeper dive into your specific area, let me know. I might cover it in the next video. Stay informed. Stay prepared. And I'll see you in the next one.